Welcome to Unfoolish Investing, everybody. I'm one of your hosts, Victor.
I'm Larry. Episode 5. Not
All
The
right.
Empire Strikes Back.
No, no, but it's amazing. It's amazing that we've made it to 5 episodes. And we appreciate everybody that's been checking out our videos and has joined us on this journey. Today's episode, we're going to talk a little bit about some of the stuff we have in the past and just double down on it. And that is the set it and forget it, the unfoolish way of investing. And just to give a little bit of background, set it and forget it is a strategy that emphasizes the importance of sticking to a long-term investment plan without constantly tweaking or second-guessing your decisions. Sort of the opposite of what happened the previous Monday when everybody sold all their stocks, dropping the market 1,000 points. And then on Tuesday, we're like, why did we do that? And then they started to buy back in.
Yep.
Which we have now, if I'm correct, Larry, as of airing of this, we have erased all those losses and we are continuing on the upward trajectory.
Back in the green like it never happened. And if you had money to put in at that time, you compounded your gains a little extra.
It's so true. And this approach isn't about ignoring your investments, but rather trusting the process and letting the time and work, it's magic. That's the secret to compound. Yeah. That's the secret to unfoolish investing. It's an idea that's rooted in the principle that markets tend to grow over the long term, not the short term. I think we can both agree, Larry, that when the market drops, as we have seen over the past couple of weeks, it drops pretty quickly.
Yeah. If you look at the markets long enough, you just see that the drops happen really quickly and the recoveries happen much slower over a longer period of time. So I'd agree with you. Yep.
And I think with that, let's just jump in, shall we? Episode 5, Set It and Forget It Investing. We just introduced the concept a little bit. I want to talk a little bit about the psychological benefits of the set it and forget it investing strategy. And for me, one of the biggest advantages of this approach is the reduction in stress and emotional decision making. Because I think we can agree the market can be a roller coaster, whether it's news cycles, economic events that are causing frequent ups and downs. Again, Going back, what happened in Japan with the Nikkei impacted what happened in the U.S. with S&P and NASDAQ. Would you agree?
Yep. Yeah. I mean, there's no way you could have prepared for that either as like a normal investor. There's no way you could have known, okay, all these yen carry trades are going to have to unwind and people are going to have to sell off huge amounts of stock to repay that leverage that they had. So it's better, to your point about you've got on the slide automation here that you don't have to do anything yourself. It just, you buy the stocks automatically, ride it out, and that really becomes a buying opportunity instead of a opportunity to panic and make a mistake.
So would you say it's pretty easy to get caught up in the emotion of big market drops as you see people make hasty decisions, and in those decisions they do things that hurt them long term, like selling on a big drop?
Yeah, I think I said this earlier. It seems to be that the stock market's the only market that doesn't like a discount. So when people start selling, more people start selling, and it snowballs. Where really it should be the opposite, where if nothing's changed in the fundamentals of whatever you're looking at, why would you sell it?
I agree, and I think by committing to a strategy like set it and forget it that doesn't require the average investor to have constant oversight,
Hmm.
you're less likely to make those impulsive decisions. You know,
Yep.
I think research, you know, the more you dig in, has shown that investors who trade frequently often underperform the market versus those in the unfoolish world like ourselves, which are just buying in regularly, no matter what the price, and staying the course.
Yep. I mean, some great examples are Coca-Cola and American Express. If you look at Warren Buffett's portfolio, he's held those stocks for 30 or 40 years and hasn't necessarily added to them, um, but believes in the companies enough to put billions of dollars of his money into it and then reap the rewards over the decades.
Yeah, no. And I think 30 to 40 years is a whole lot of compounding and a whole lot of growth when you look at those stocks over that
Mm-hmm.
time. And that kind of brings us into the role of automation, and which is key to the set it and forget it mentality. Um, by automating your contributions, whether through
Yep.
direct deposit, which I currently do. I have with my employer, I have my direct deposit from my paycheck. I have a small amount go into a separate, and for me personally, I use SoFi um, bank account where I don't see it. It just is a high yield savings account that just continues to grow at the higher interest rate
Mhm.
and keeps me growing my wealth without it impacting my day to day because it's over here and that's not where I'm spending or taking most of the money for my bills out of. Um, what are your thoughts on, utilizing your paycheck and direct deposit for that type of mentality?
Yeah, I do the same thing. I don't use SoFi, I use Discover. Um, it's just something I set up ages ago. And to your point about setting it and forgetting it, um, it just comes out of my pay every 2 weeks, goes into that account. I forget about it until, I decide I need it for something. And I look in there and see how much money I have. And usually it's a lot more than I thought I did because it's out of your mind. You never see it. It's like it doesn't exist.
Yeah, and I think that to me is you know, key when you have
Mm-hmm.
money coming in, um, and you're not seeing it. You know, another great way that I personally tell people uh, to use set it and forget it is when you get a raise. Should you get a raise at the end of the year, even if it's as little as 3%, take 1% of that raise before you start collecting it in your paycheck and put it into your 401k. You've already lived the
Yeah.
previous year in this world without that money. So putting it into your 401k is just another way of taking that 1% and setting it and forgetting about it for your long-term benefit of your retirement. Um, have
Yeah.
you ever heard of that before?
Yeah, so my employer actually offers that through our 401k program. They'll actually automatically, you have to opt into it, um, but they will automatically increase your 401k contributions by whatever percent you set every year. So you can have it set automatically so that every year your 401k contribution goes up 1% or 2% or half a percent. Um, and to your point, lifestyle creep is real. Um, you've lived without that money before. The more you can put away now, the less you'll have to later.
Yeah, and I think that, when another way that you can even add to the set it and forget it mentality is automating rebalancing of your accounts to help maintain your desired asset allocation inside of your portfolio, if everything's set up to automatically rebalance, it eliminates the friction, the decision making. What do I do? How do I do it? And it allows your investments to continue to grow systematically over time. Um, and again, you're not thinking about it. It's just doing it. And
Yep.
that to me is the most important thing that I tell people is that when you set it up and you forget about it, your wealth is going to continue to grow long term because you don't need to look at it. You don't need to worry about it. Shut
Yep.
media off. Don't look at the market drops. Just know you're going to be fine as long as you continue with that long-term strategy.
Yeah. I will say that I don't rebalance automatically. I think that rebalancing is, it's up to everyone's own personal risk tolerance. Um, so like you and I have talked about this offline, with Nvidia, where Nvidia's become a pretty large stake um, in my portfolios, that I haven't really pared down too much yet. Um, where if you were rebalancing automatically, you probably would have reduced it drastically, um, as opposed to me where I'm kind of diamond hands holding it, to see how high it goes over the next 12, 18, 24 months. I've pared it down a little bit though.
Is that sort of like letting your winners run?
Yeah, that's kind of how I see it. I've done the same thing with CrowdStrike, where CrowdStrike, um, I bought quite a bit of it years ago at a really low level. Um, that even through the volatility that we've seen the last like couple months, um, it's a 200% gain for me. So I'm happy that I haven't rebalanced anything. Um, so like I said, it's all personal risk tolerance. I do fall into that camp of letting your winners run over automatically rebalancing.
That's a fair point. That's a fair point. And I think that there is benefit to both ways.
Yep.
And I think for there's no wrong one because if your winners are winning, you continue to drip into it, you're going to do well. If you rebalance, you're still going to do well.
Yeah.
It's how much automation do you want to add to your portfolio and how much additional thinking. So that's
Yeah.
kind of
And see the point about risk tolerance and the automation piece of it. Um, if you have a stock that's done really well and it's stressing you out that it's gotten to be such a huge piece of your wealth in that account, then you probably should sell some of it. Like say you have a ton of Nvidia and it's 30% of your portfolio, and like there's a chance it could go down by half. It's such a volatile stock that if they have a bad quarter, it's going to tank. Um, so if that keeps you up at night, then you should probably rebalance.
agreed. And I also think that for any unfoolish investor out there, they should look at their particular age as well, how close they are to
Yeah.
retirement. Even though staying in the market through retirement is important,
Hmm.
maybe you want to pare back and be a little bit, you know, more
Yeah.
balanced and take away that risk. But again, it really depends. If you don't want any risk whatsoever, I'm not sure
Hmm.
you should be in the stock market at all.
Right.
And
Right.
I'm not sure we're the right podcast for you. But I
Yeah.
think that the stock market as a whole has shown that long term, it's a
Yeah.
winner. It's betting on America.
Yeah. I have a pretty good example I can go into for a second here.
Sure.
Um, when COVID was spiking and offices were closing, everyone was going home, um, and the stock market was plummeting, for lack of a better term. Um, I actually had people in my office come up to me and say, how do I liquidate my 401k? Like people close to retirement. How do I liquidate my 401k? I need to get it into money market accounts. I'm losing my entire retirement overnight because the market was going down 10-15% a day there for a stretch.
It was horrible.
Um, people like in tears because they were seeing everything they had saved vaporize. And, I tried to caution them. I don't know if they took my advice or not, but I said, that's the worst thing you could do is to get out of the market. You didn't get out of the market when it was 50% higher. Why would you get out of it now when it's down by half? You've got to take the emotion out of it. This is going to be a temporary thing and just stay the course. And hopefully they did, because they would have sold at the absolute bottom with no potential to recoup any of that loss.
Yeah, no, that's a great point, and I think that that's where the emotion
Mm-hmm.
comes into play, and I don't think that the media out there helps us in
Yeah.
calming people during this, because I think it looks too pretty when they put the giant picture up there with everything collapsing into the sea and crumbling, and now people are
Mm-hmm.
like stressed out. I just lost my 401k, and I'm like, you're going to be fine.
Yeah.
You're going to be fine. We're in a hiccup.
Yep.
We will get out of this hiccup.
You don't you don't lose it if you don't sell it. You've locked in the loss when you sell it.
Agreed. And with that, I think we should pivot on over to choosing the right investments for the set and forget it strategy. And I think we both agree low cost index funds are often recommended. I believe we've talked about VOO, QQQ, and even getting into a little Berkshire B stock.
Yep.
Um, very low cost. I think VOO will cost you after 10 years, if you had like $50,000 in there, something like $36. Um,
Yeah. I think it's 0.01 or 0.02% expense ratio. Very small.
and to start out there with those three is probably the best investment strategy. For any financial advisor that's watching, I am not the person for you, because I don't believe anyone out there needs a financial advisor at any level to manage their money if they're putting their money into VOO, QQQ, and Berkshire B stock, because those three alone will diversify you and ensure long-term growth for generations.
Yeah. Yeah. Those are the three. Set it and forget it. Thank you, Ron Popeil. I'm just going to keep thanking him forever.
He's amazing.
Um, those are the three really set it and forget it. Equities or indexes that you can put into. Maybe we'll have an episode in the future on Berkshire B. They've kind of moved some money around over the last month or two. Further, I think diversifying.
Agreed. I never thought, just because you brought it up, I never thought I would own stock in the beauty industry. And now, being a Berkshire investor, I
Yep.
own so much stock in the beauty industry, and I'm
Yep.
like, and I'm fine with it. I'm fine with
Yep.
it, because I feel like they're seeing something, you know, whether it's the I word with inflation or the R word with recession, because
Yeah.
the media is going to be pushing one of those two words. It's the only thing they can talk about.
Yeah.
They're seeing something, and I personally think they're seeing a 30% discount in a strong company.
Yeah. I think it's he's always been a value investor. And that seems like a screaming value. We'll probably go into it in a future episode, I think. Take a deeper
Agreed.
dive.
And I think that, and that goes to the next point of the set it and forget it mentality. And we talked about that. We're going to continue to talk about it. And that's the
Hmm.
power of compounding. And as a parent of three amazing children, I cannot tell parents enough out there how important it is to compound your money, your kids' money over time. Because as simple, and we've talked about this, investing $50 in a child's VOO QQQ in Berkshire B right when they're born and only putting in $50, $50 a month, and then maybe adding $10 every year. So year one, 50, year two, 60. That child is going to be a millionaire by the time they turn 40. That's the power of compounding.
Right.
That is why compounding is so important, that you can make your child a 40-year-old millionaire. And it's not because you did anything other than trust in the market and compounded interest.
Yep. And that child or children literally did nothing.
And
Didn't have to do anything.
they didn't have to do anything, and they could probably have their own money, their own career, and everything else by the time they're 40 that's established. And now they have this extra $1 million plus just lying around just to make
Yep.
sure that they're comfortable in life.
It's a
And
nice problem to have.
it
Extra
really
million
is.
dollars.
It really is such a nice problem to have, and it's so simple. It's so simple, and it's just the power of compounding.
Mm-hmm.
Um, you know, one area that I don't think, we talk about enough would be the common pitfalls, And I'm going to get a little negative here because there are common pitfalls of the set it and forget it strategy. Um, Market timing, trying to predict when to buy something or sell it based on short-term market conditions. That's
Yep.
probably one of the biggest mistakes investors make. The
Yeah,
reality is that no one, I don't care what financial advisor level you are, how many millions you have, there isn't anybody on the planet that can consistently predict market movements.
well, I mean, I think we had a great example the other day about timing the market where you had a limit order in for CrowdStrike at a certain level and it just missed and you didn't buy it and it's up 30% since then.
Thanks for bringing that up,
You
Larry.
just have to buy it. Time in the market beats timing the market. Just
And
buy
I
it.
know.
If you love the company, just buy it. Forget about it.
And it's crazy because I should have done that. And it is at that particular point that I kind of pivoted. I did something that I very rarely do, which is every now and then I go into my stock portfolio and instead of hitting market buy, which I do 99% of the time,
Yep.
I'm like, oh, everything's in the red today. I'm going to try and guess, and I think it's going to go down to
Mm-hmm.
$190.50. And I'm like, I'm just going to do that today. I don't know
Yeah.
why. And
I've done it before too, and I've gotten burned. And I just said I'm never doing that again.
and it and it's that pitfall that I have to eat, but it also taught me a lesson,
Mm-hmm.
to your point.
Yep.
And the lesson that I learned was that, you know what? I should have just set in and forget it. I should have just put in
Mm-hmm.
an order for a market buy first thing in the morning, and I would be done. I would
Mm-hmm.
be done.
Yep.
And then I'd have that 30% that you just pointed
Unfoolish investment lesson learned by
100%.
us.
Yes, yes. I
You
mean,
know.
we all make mistakes. We all
Mm-hmm.
make mistakes. It's owning those mistakes and learning from them,
Exactly.
which
Exactly.
is the
Yep.
most important thing. And for me, I'm like, it just taught me, I'm like, what was I thinking? This is not even my strategy. My strategy is just to buy it in. This is a good price. $200, $203 versus 190. It's still a great price.
Right. In 10 years, when it's 600, that $3 difference is meaningless.
I still feel like it's meaningless today when the price is at what, $260 versus
Yeah.
$200. I'm like,
Yep.
what was I doing? I just lost 30%. Um, but that that is just a pitfall that I fell into that I should have avoided. And you know, with that, let's talk a little bit about monitoring and adjusting, but not too much. While set it and forget it doesn't mean never looking at our investments, and am guilty of looking probably more often than I probably should. Um,
Me
just
too.
because I'm talking about it. I love the stock market. I love
Mm.
buying in companies, and you know what? I'm in it all the time. It does mean that we need to try avoiding unnecessary changes. It's important to periodically review our portfolios to ensure they still align with our goals. And we talked about our risk tolerance. Some of us
Yep.
have more than others. It's knowing what your risk tolerance is. If your
Mm-hmm.
risk tolerance is very low, keep with the three staples of unfoolish investing and go. If
Yep.
your risk tolerance is higher, ride that NVIDIA wave.
Yep.
You know,
Yep. If you're gonna lose sleep over it, or it's gonna distract you in the rest of your daily activities, then you've it's too much of an allocation. You should probably draw it down.
agreed. And I think that is probably the one thing that people should do is just understand your risk tolerance. And
Yep.
and if you're going to try out going into one of the stocks that we talk about and we recommend, that you do it with 1% or less than 1% of your overall portfolio to start, just so you're not buying too much or you're unsure of how much to buy in. Because some people have two different mentalities on the market. There's the mentality of, let's just go all in right now on this one stock. I have $1,000. I'm just going to put it all in. Then there's the unfoolish mentality, which is a little bit more of, well, let's buy $250 right now, or let's buy $333 right now. And over the next 3 months or 4 months, right, we're going to continue to buy. We'll buy at different levels. The $1,000
Yep.
is going to get in there, but it's going to be a little bit more diversified than just lump summing it all at once.
Yep. Totally agree. I think CrowdStrike, great example. Say you bought $1,000 right before that outage. You'd be down 30% now. Where if you bought $250 then, it went down 30-40%. You bought another $250 2 weeks later, and then another 2 weeks goes by, you got another $250. All of a sudden, that one lump sum that would have been in the red, you've made some money on that.
Agree. And again, it definitely goes both directions.
Yeah.
It could go up, it could go down, it could go both ways over the
Yep.
span of those couple of months. But the importance is diversifying your timing when you're buying those particular stocks. And if you do that and you start with 1% of your overall portfolio as you start buying into stocks and you spread that amount out, you're going to do well. You'll do well. Um, any final thoughts today as we kind of wrap up talking about the unfoolish set it and forget it strategy? Um, you know, for me, it's about embracing the long game in investing. That to me is the most important thing. It's disciplined, it's patient, it allows an approach that allows you to build wealth steadily over time, without getting too caught up. And we've spoken about this so much in the daily noise that the media pushes out around the markets. It's about automating. It's about choosing the right investments to start with. And most importantly, it's about avoiding the temptation of when to buy, as I learned and I fell into, um, in the market. Um, and it's going to help you achieve your financial goals. It's going to help you achieve your children's financial goals. And for me as a parent, if I can help my kids turn into a millionaire by the time they're 40, I've done my part. And it's just falling on. Yeah, I mean, even I won't be. There's a good chance I won't be here, but they'll have something. They'll have something, um, and it's just, even if it's just that unfoolish philosophy of compounding over time is the easiest way to build true wealth. Well said. Thank you everyone for joining us on episode 5 of Unfoolish Investing. If you enjoyed it, don't forget to hit the like and subscribe button. And until next time, everyone, stay unfoolish.